This opex is unusual. All the weird behavior we've been discussing over the last month could be about to change next week, and here's why. Often, expirations come with supportive flows. In fact, you're probably most familiar with expiration because you've heard people talk about supportive opex, Vanna, and charm flows. But the reality is that is not an automatic given. That depends squarely on the position. And if you've been paying attention to our channel the last month, we've been drilling the point that the position is inverted. If the position is inverted, you need to prepare for the opposite of the normal thing. And if the normal thing is usually to drift higher, well, prepare for a more flat or a bit bearish of a week next week as the August positions expire. The usual effect we see at expiration comes from the very simple case that most of the world owns stocks. And because they own stocks, they have to buy puts to hedge them, and they sell calls to finance them. This produces something called a skew in the index. As a market maker, you're wearing the other side of this position. We sell the world their puts and we buy the calls from them. When we do this to hedge it, we sell futures. But as we march towards the expiration date of this position, the options become more and more out of the money. Their deltas drop off due to charm or decay, and we have to buy back those futures. This is the origin of much of the index's drift. But again, for this to be true, the position has to be normal. But right now, it's still not normal. And the range that we're contained in is the opposite of what we usually get. Let me show you the position expiring next week and exactly what's different about it here in VS3D, our dealer hedging platform. So this here is the August inventory. You can see here that this is market makers. These expirations are the August AM and the PM positions, the ones expiring next Friday, the big cycle. Now, when you look at this, it might appear pretty noisy, but I want you to focus on the shape here. Remember, dealer shorts, things that customers buy to hedge, these show up on the left-hand side of these orange bars. These are short positions that produce negative gamma, negative vega for the option market maker. On the right-hand side are dealer longs. These are places where customers have sold options to market makers. Oftentimes, these are overwrites. Now, you can normalize positions in VS3D. As you see here, this looks a little bit different. When we show strikes bucketed by 10, this allows some of the shape to show itself. Remember, when options expire, they produce forces by way of the market maker's hedging requirements. When you expire a position as a market maker, short positions create negative gamma and a charm influence that forces us to hedge in a way that pushes the market away from the strike. We talk about this in onboarding all the time. When you have a long position, the long positions create positive gamma. They create what you may have heard of as pinning. The reason is, in either dimension, spot movement or time, all of the hedging behavior redirects the market towards the dealer long. And so when you look at these positions, you're looking for a shape. And the shape is going to be flanked by dealer shorts, creating a range, and inside that range, an obvious place where the market may settle. And here it can't be more clear once you understand what you're looking for. You have hedges everywhere, right? We've had spot up, vol up territory for the better part of August now. We've had negative gamma through a good chunk of this range to the upside, and a lot of this position is causing that. What you can see here is that the only real settling place, again, the settling place being where the dealers, the market makers, own options and own gamma locally, is right around 77.5. Now, what's interesting about this, August was very different than the months preceding it, right? If you recall, we had spot up, vol up market behavior in April all the way to the end of May. And then we saw the market snap into a totally different set, totally different frame, and actually have a serious sell-off in June and another bit of a swoon in July. And how far did we run after July? Well, interestingly enough, on the morning of July expiration, the August AM straddle was worth $278. If you add that straddle price of $278, the market's expected range at that moment, July was expiring, to the market's level at that time, you get 77.48, which ironically, or not so much, is almost exactly where this position would imply settlement. All of the balancing act, dealers pushing away from shorts in this range, pushing down away from shorts in this range, coalesces to the same place. There's consolidation behavior. There's a pinning mechanism that leads us back to right around 77.25 through 77.50 for the August expiration. So if you're expecting more spot up, vol up behavior next week, maybe don't. If you're expecting the market to have supportive charm and Vanna at its back for an easy drift higher into the 78 or 7900s, the position does not compel that. In fact, the positions themselves, as you can see right here, suggest that the range boundary might have just been tested and the fade makes a lot of sense. The most likely pin for August would be right around 77.5. Now, if you're expecting us to just be off to the races when that expires, remember, These positions create the structure for the entire cycle. And so when this position snaps off and expires, don't expect the same behavior. And so what comes next? Well, if you want to know more, sign up for our free weekly newsletter that I've just restarted with really great deep dives breaking down not only the position and the influences we've seen during the week and the big trades, but also what this means for the week ahead. You can find the link in the description below.